All right, it's another Friday afternoon, and apparently, it's rough to stay awake because it's just right after lunch. Hopefully, you got a nap. If you didn't get a nap, I'll do my best to be enthusiastic about homework to keep you awake. Um, so just as a couple of reminders, so we've got an exam next week on Wednesday. I was taking a look at the exam and making some finishing touches and updates. We will have an exam review on Monday. I don't know why I was struggling with that. But we'll have an exam review. We'll talk about the study guide and the exam. So something I want to make sure that you're clear on the exam. Just because it's not something that I explicitly put in slides does not mean it's something I won't test on. Hopefully you took diligent notes and paid attention closely to some of the things I talked about. I will review several of those things we talk about on Monday. But review your notes, review the things that you wrote down. If I talk and I just basically talked really slowly and repeated something over and over again, that means that's probably something that's important you should know for the exam. But yeah, it'll be 50 minutes. It's 12 multiple choice questions and 2 problems, I believe, is the way I have it set up. Traditionally, it's not been an issue for most people to finish. It's about 30 minutes for most people to complete, but you have the full 50 minutes if you need it. With that, let's go ahead and talk about some homework stuff, shall we? Let's work through what we got here and see that everybody has got their knowledge on for chapter 5, which, like I said, an important chapter to understand for this particular course. All right, question 517 says, which of the following procedures would an auditor most likely rely on to verify management's assertion of completeness? Now, let's go ahead and talk a little bit about completeness because we need to make sure we understand the nature of it. Completeness is our recording assertion. And I know that you're thinking, because you're already thinking about this way ahead of time. It's like, Dr. Barnes, we technically have 3 recording assertions because you say VAA is a recording assertion, as is cutoff. When I say completeness, I'm specifically saying, did something get recorded, full stop? Okay. Did it get recorded, full stop? How do we test whether something got recorded? We go and look at the source documents, and then we go compare and see what's in the system or what's in the financial statements. So we move from source to record. What direction is that, by the way? Up, yep. Starting the source, moving up. Thinking about building a tower. We got to have the foundation before we can finish the stuff at the top. So we're moving up. That's why tracing is our test of completeness. Okay. And also, we're going to note something really, really hideous here, which I think I forgot to mention when we were talking about it, our evidence types. Be very, very careful with the terms vouching, and particularly with the word tracing. They mean specific directional, they're related to specific directions and specific assertions. The book and sadly the AICPA like to use the word tracing when they're not specifically talking about the term tracing. So anytime you see the word tracing, you can't just take it at face value that that's what it means. I won't try to fool you with that on the exams, but you definitely will see some of that in the homework. You do need to evaluate in every scenario what the direction is if we're talking about a directional assertion. All right, so if that's the case, we're starting with source documents or moving to records. Which one of these answers most completely or kind of follows that pattern? Well, we start with a sample of shipping documents to related sales invoices. Okay, so B basically kind of talks about that direction because as we know from the revenue process, we ship something out, and then once something is shipped out, we have the justification to bill somebody. So invoices are generated from the fact that we shipped something out to a customer. So the source document generates a later document in the chain. We're moving from one point up to the next point. So that's how we're testing completeness. That's the most likely direction we're talking about for B is comparing a sample of shipping documents to related sales invoices. All right, 518. In testing the exist assertions for assets, auditor ordinarily works from the what? So existence occurrence is basically the opposite of completeness. We see something has been recorded in the system or recorded in the financials. We want to make sure that it actually exists. So completeness says this exists. Did it get recorded? Existence occurrence says this was recorded. Does it exist? In that case, if we're moving bottom to top, if we're moving upward for the completeness assertion, which direction are we moving for existence? Down. We're going the opposite direction. Okay. So if that's the case, then we want to look at starting the top and going to the bottom. So let's go ahead and look at the answers. Financial statements of potentially unrecorded items. Financial statements would be a good start because that's where we would start, but potentially unrecorded items would be something that we would actually want to be concerned about with respect to completeness. So that's not a good direction. Potentially unrecorded items to the financial statements. Again, that's not going to be a directional test because those are kind of the same level. Accounting records to the supporting documents. All right, here we go. Accounting records are going to be what we have in the system, and we want to say, we know that this is what's been recorded. Can we find evidence of what's been recorded? So we're going to move down to those source documents. So record to source, that's basically what we're talking about. So C is our answer. Supporting documents to the accounting records, that's going to be that's the opposite direction. That would be a completeness test. All right, 521 is our next question. Which of the following types of audit evidence is the least reliable? The least reliable. So how do we determine whether something is reliable or not? What's the criteria for something to be highly reliable? Prepared by who? The auditor. The auditor prepares something that's highly reliable, okay? If we're entirely reliant on the client, then we're talking about something that's much lower reliability. So in this case, we're looking for kind of a continuum. Now, remember, we talked about the AEIOU mnemonic, which I said, just remember the first 4 letters because the U is a joke. But auditor generated evidence, externally generated evidence, internally generated evidence, then oral evidence, which oral evidence is our observation and inquiry. So if that's the case, let's go ahead and go through this. Pre-numbered purchase order forms, that sounds kind of good. I like pre-numbered purchase order. That's something that's already been completed in advance. Prepared by the entity. All right, I don't like those last words. I don't like those last words. So this may be our answer because prepared by the entity kind of gives us clue that this is going to be least reliable. Bank statements obtained from the entity. Okay, so is this going to be more or less reliable than those pre-numbered purchase orders? More reliable. It's external evidence. Yes, more reliable. So we're going to say B is probably not our answer when we got A. Test counts of inventory performed by the auditor. What do you guys think? Must be highly reliable because that's something we're doing. Correspondence from the entity's attorneys about litigation. Again, that's going to be an external party providing information, so that external evidence is probably more reliable than a client. So A is our answer because that's completely reliant on client information. All right, well, we enjoyed that so much. I saw a big smile on everybody's face for that question. Let's talk about reliability some more. What do you guys say? Audit evidence can come in different forms to different degrees of reliability. Which of the following is the most persuasive type of evidence? All right. Well, if that's the case, then we know we've got our continuum. Let's just go ahead and go through the answers. Bank statements obtained from the entity. Is that the most reliable? No. Computations made by the auditor. Well, we probably don't have to go any further, but let's make sure we see. Pre-numbered entity sales invoices? No. Vendors invoices included in the entity's files? No. That computations made by the auditor, that's recalculation. That's a really high reliability type of evidence. That's a clear winner. Clear winner there. So B is our answer. 524 says the assurance bucket or the assurance Chipotle burrito, whichever you prefer, is filled with each of the following types of evidence except for what? So remember the sequence that we walked through. We talked about at the very beginning during planning and risk assessment, we obtained some assurance. Then we say, all right, we know the direction of our audit. Let's go test controls because if we can get some assurance from controls, we can reduce the work that we have to perform. So assurance provides some more control. So we fill the bucket up a little bit more. Then we perform substantive analytical procedures, try to make some estimates, get some assurance in that regard, fill it up a little bit more. And then finally, at the very end, we fill it to the top because we've got our substantive test of details. What was left out there? The audit report. The audit report is something that's generated after we have obtained all the assurance we need. So the audit report's not part of the assurance bucket. So that's our answer, B. The current file of the auditor's working papers should generally include what? So current file deals with items that are relevant to the current period under audit. All right. So what's something that was generated during the current period? What do you guys think about financial statements? Those are pretty much generated on an annual basis. So I'm pretty happy going with a copy of the financial statements in the current file. To flip that, permanent file contains what? Okay, contains what? So this is going to be items that are consistent and stay static over time. They can change, but they don't change as frequently as things in the current file. So what do you guys think? Accounting system and control procedures, narrative descriptions of that, are that going to be relatively stable? Yeah, I think D is our answer for that one. And then 529. The substantive analytical procedure known as trend analysis is best described by what? All right. So what is trend analysis? You knew that before you ever walked in this classroom. You've done that before. What are we doing when we're looking at trend analysis? We're saying, all right, back in 2020, this account was here. 2021, it was here. 2022, it jumped to here. 2023, all right. So we're looking at changes in account over time. All right. That's all there is to it. The examination of changes in an account over time. C is our answer. How do I feel? Pretty good about that? Feel like you're ready to take the exam right now? All right, clear off your desks. I'm just joking. I don't have the exam printed out yet. But if I did, I still wouldn't do that. That's a way to butcher your evaluations at the end of the semester right there. Top exam. Yeah, there we go. All right. 532. So we're gonna do 532 and 533 together. So basically what we've got here is we've got some examples of some items here, some examples of testing. And there were a few interesting questions that were related here. So you had to actually specify, first of all, what type of evidence is being generated here. Secondly, you're going to be talking about in 533 was account balances or transactions and events, okay? And then what is the primary assertion being tested? Now, I want to talk about that second part because that's an important point to make. When we talk about account balances, that's generally what is the information that's currently in the financial statements. All right, an account statement, or financial statement line item is what we're testing. Whereas transaction events usually relates to daily operations. That's frequently related to controls, but it can be substantive analysis as well. So basically, we had to answer all three questions. And for each of these line items, we're going to answer each of these three questions. We're not going to do 32, then 33. We're going to do them together. Okay. Sending a written request to the entity's customers requesting that they report the amount owed to the entity. So what type of evidence is this? This is a confirmation. Yeah. Third-party request. All right. What's our category of assertions? Is it account balances or transactions and events? Account balances, yes, okay, because we're asking, we're trying to determine what is the balance of accounts receivable by sending this out. So we're trying to actually test that balance. All right, so this is account balance testing. And given this nature of this test, what assertion do you think we're testing? And this is an interesting one. This actually relates to something we talked about on Wednesday. We were saying that confirmations can test all assertions, but there are two primary assertions that it tests. It tests existence, occurrence, and completeness. The question is, which one is the primary assertion we're testing here? It's a 50-50 coin flip. What do you guys think? Existence occurrence, very good. Why? Is it more likely that a client is going to over-report or under-report accounts receivable? Over-report. They're going to make their assets look better rather than worse. So we want to make sure that they're not reporting things that don't exist. All right. So that's why existence occurrence is our bigger concern. All right. Examining large sales invoices for a period of 2 days before and after year-end to determine if sales are recorded in the proper period. Okay, what do we got? Examining sales invoices. What does that sound like to you guys? Sounds like accounting records. What do we call that testing of accounting records? Yeah, inspection records and documents. Very good. Okay, we're inspecting records and documents. Okay, if they're records and documents, we're probably relating to individual transactions. So when we say these are transactions and events, yeah, okay, we're talking about assertions related to transactions events. And what's our assertion specifically here? Cut off, yes, because we're talking about recording it within a period of time. Very good. Agreeing the total of the accounts receivable subsidiary ledger to the accounts receivable general ledger account. All right, this one's a bit dicey, all right? This one's a bit dicey. So there's actually two different types of evidence we could be talking about here. You could make an argument that this is expected in record documents because these are accounting documents. These are accounting items we're looking at, okay? But the book makes an argument that there's actually another type of evidence that we could be collecting here. Anybody want to guess what it is? It's a but it's not recalculation. Reperformance, okay? We're reperforming tasks to make sure that we come up with the same results, that anything that gets put in the subsidiary ledger was recorded the same way it was, all right? That being the case, the category of assertion should be pretty obvious here. Account balances, yes, okay. And what do we think we're testing here? This assertion is a little bit more tricky. This one's a little bit more difficult to figure out than the others. So think about direction. What gets generated first, the subsidiary ledger or the general ledger? Subsidiary ledgers get generated first because those are account level transactions, and then they all combined and consolidate into the general ledger. So we're moving from one source of information, moving to where the record of all that information will be. So we're moving from bottom to top, meaning we're testing. Directions are really important, guys. You got to know these. Completeness. There we go. Bottom to top is completeness. Okay. Remember, tracing with a hat on top of it, pointing upward. Okay. Completeness. All right. Discussing the adequacy of allowance for doubtful accounts of the credit manager. All right. Type of evidence. This is easy. Is inquiry. Yeah. Inquiry. Okay. Is this account balances or transactions and events? Yeah, it's talking about a specific account, so the balance in that account, okay? And the assertion should be pretty straightforward on this one too. Starts the letter V. VAA, yes. Remember I talked about allowance for doubtful accounts, so whenever you see that term, you should always think VAA. It will always be the situation where we're talking about allowance for doubtful accounts, making sure it's properly valued. Comparing the current year gross profit percentage with a gross profit percentage for the last 4 years. All right. Type of evidence on this should be pretty easy. Begins with the letter A. Analytical procedures. Yes, analytical procedures. Also, the category of events also starts at the beginning of letter A. Count balances. Count balances. Okay. Question is, which assertion are we testing right here? So there was only 2 assertions that we could do for account or for analytical procedures. Which one do we think is the most likely? So first of all, what were the 2 assertions that we could do for analytical procedures? You guys remember? Had a little bit of discussion about it. I said 90% of the time it's going to be VAA, okay? And that's the case here. It's VAA in this situation. What was the other one that's like 10% of the time? Completeness. Yes, very good. All right. Examining a new plastic extrusion machine to ensure this major asset acquisition was received. All right. So what type of evidence do we think this is? Inspection of tangible assets. Yes. Big old machine. We're going to inspect it to make sure that it's in place. All right. What assertion, what category of assertions are we dealing with here? Count balances, because we're probably talking about a line item within property, plant, and equipment, and we're trying to verify that amount is correct, okay? And then the assertion here should be pretty straightforward, because in inspection of tangible assets, only test one assertion. Which one is it? Existence occurrence, yes. And does that make sense? Do we want to make sure that this big old asset actually exists? Probably so, probably so. All right, watching the entity's warehouse personnel count the raw materials inventory. This is an interesting one because this will actually delineate some information. So if we're watching entity's warehouse personnel, what type of evidence is that? Observation, observation, okay. What category of assertions do we think we're dealing with here? So we're not looking at individual transactions, we're looking at the inventory items that comprise the balance in the financial statement. So we're talking about account balances. All right. And interesting question. This actually relates to another part of the homework assignment. What assertions do we think are the most common here? There's actually multiple assertions we could actually be testing here. Probably our most primary assertions are going to be completeness and existence occurrence. Why? We're going to talk about that when we get to the EWC testing, inventory testing, because that's actually pretty enlightening. But yeah, observation, account balances, completeness, existence, occurrence. All right, but then we decide, you know what? We're not just happy just watching people do it. We want to do some counting ourselves. So we're going to perform a test count ourselves. Now, the last 2 things, account balances and completeness, existence, and occurrence, those remain the same, but the evidence that we're collecting has changed. What type of evidence are we collecting now? So our reperformance, yes, our client is doing a task and we say we are going to do the same task and see if our results match with what the client is doing. That is a reperformance task. Which is going to be higher reliability, observation or reperformance? Reperformance, because we're the ones doing it. We're the ones doing it, which is why we do those test counts to get a little bit higher reliability test. Obtaining a letter from the entity's attorney indicating that there were no lawsuits in progress against the entity. All right, type of evidence, pretty straightforward. What do we call this? Entity's attorney is a third party. What do we call a third party request? Confirmation, okay. And then lawsuits against the entity, we're probably concerned about whether or not they've been properly accrued or treated in the financial statements. So if it's something in the financial statements, it's probably category assertions, which account balances. Yes. Okay. Account balances. And what are our assertions here that we're concerned about? There's actually probably multiple assertions here with respect to this. We're probably talking about making sure that everything that should have been recorded get recorded, which if that's the case, what are we talking about? Completeness. We're also making sure that they got recorded at appropriate amounts, which would be VAA. Very good. So completeness and VAA. All right. Tracing, which I use that term very, very loosely. This is not the appropriate term of retracing. So if you wrote down completeness on this one, so I'm sorry. I'm very sorry for you guys. All right. Tracing the prices used by the entity's billing program, pricing the sales invoices and the entity's approved price list. So this is obviously inspection of records of documents because we're looking at certain documents to make sure they're consistent with one another. This is obviously transactions and events because we're talking about individual invoices and comparing them back to the original program. But tracing, is this a tracing test? Obviously no, because I said it was not a tracing test. So it's not completeness. What do you think, what assertion is most likely being tested here? I think you could make an argument for existence occurrence, but I think there's one that's actually primary to that one. I do have existence occurrence written down here on there. but I think that there's one that's a little bit more. So looking at invoices and making sure that the amounts that are invoices are consistent with what's in our system. We're comparing amounts. VAA, there we go, VAA, that's going to be our primary one. So those last few were kind of challenging, kind of tough. It's important to understand those assertions, particularly the ones that are directional, so we can pull those out. All right, what do you guys say we do some analytical procedures? I know you were looking forward to it. So I told you that this one is slightly more difficult than the ones we did in class. I may have understated that.
It's good. I did the math.
So don't worry too much about the math on this one. We want to make sure we understand the intuition. So I'm not going to read through this, but we're going to talk about each of the different scenarios. So there are basically 7 games that we needed to be able to identify. And so let's go ahead and talk about our default assumptions, and then we're going to talk about what adjustments we had to make. So first of all, one of the things we're trying to make inclusion on is we're trying to develop a model here. And this is far more complex of a model than one we did for our interest expense. This is a calculation of revenue, we're trying to determine a revenue estimate. Now, is that one of those things that you all have very comfortable with? Did you do a lot of revenue estimates in your previous accounting classes? I mean, to some degree, but it's very largely fluctuates. That's really, really hard to come up with something consistent because there's different scenarios that can come up. Like you could have a group of people that just walk up and purchase tickets they weren't expecting. So revenue analytics, they are possible, but they're challenging. So we're going to see if we can come up with an answer that's consistent with what their recorded amount is. Now, the recorded amount that they came up with is $2.2 million. And that one is our comparison amount. So let's go ahead and calculate what we believe the amount should have been. So daytime games, there were 4 of them. They had 24,000 ticket sales, which they broke down as follows. 70% were in the box seats, 20% were in the end zone seats, and then 10% were in the upper deck seats. They also had the free seats that you had to remove out from there. So basically, it's just 70% times 24,000 minus 500 is 16,300. Then 20% times 24,000 is 4,800, and then 10% times 24,000 is 2,400. Multiply those times the price, you come up with these numbers here. So total for any individual game is you expect to have $246,000 in ticket revenue. All right. We can multiply that times 4 because there are 4 games that we'd apply this to. We get 984,000. This is our base assumptions. Now, the importance of getting the base assumptions right is really critical because we're going to modify those assumptions for the remaining 3 calculations. So then we say the national ranked opponent. The national ranked opponent is going to have 30% more ticket sales, which you'll notice I just took 24,000 and multiplied it times 1.3. Then we have to hold the same assumptions before, except our prices go up as well. Price increase is basically a 20% price increase. Everything else is pretty consistent. You just come up with new values of $385,920 for this particular game because the prices are higher and you have more people visiting. Then the in-state rival. In-state rival is going to have an increase in the number of seats, okay, so 20%, which would have been fine. And I didn't think they needed to add this next level of complexity, but they basically said that 4,800 were going to be 75% in the box seats and 25% upper deck. And I'm saying, like, why did you have to add that? Why couldn't you just kept it the same distribution? But regardless, we just take our same assumptions, and then all we do is we add the 75% of 4,800, which is 3,600 seats, down here to the quantity. And then we take the 25%, which is 1,200, and then that's to the upper deck seats. Everything else is consistent. So it's just basically this number up here with 3,600 added here, 1,200 added here. So $295,200. The one that's the most challenging, and the one that I have had incorrect for I had incorrect for like 7 years before I got it correct. Okay. And I'm not 100% certain that that's correct, is the evening game. The evening game has lower attendance. It's 95%. But to combat that, they increased sales price of the tickets by 10%, which that's easy enough. Where the snag was these free seats right here. Because I always wanted to put 500 for the free seats, but they actually put a note in the new edition of the book saying, yeah, the free seats are subject to the same reduction in seating as everything else. So 5% reduction in free seats. It's actually 5% less than 500, which is 475. That gives you 257.70. So you get 1,900,212 or $1,922,190. I don't know where I was going with the rest of that. Anyway, did you get pretty close on that? I mean, if you didn't get the exact amount, you were still hopefully within the range. Now, if you came up with something like $3.7 billion, your estimate's way off. Okay, your estimate's way off. But hopefully, you came up with something pretty close to this. All right. The issue here is not the calculation. I will not give you something this challenging on the exam. I may give you something to calculate that we haven't done specifically in class before, but the calculation itself is pretty easy, all right? The issue is the intuition behind this. Is this close enough to that $2.2 million? At face value, we want to say, no, that seems way off. It's like $300,000 off. But can we make that value judgment as auditors? No, we need to have a quantitative basis, okay, for this particular calculation. What's our quantitative basis? What do we say we're going to use for this course? Tolerable difference? How do we calculate tolerable difference in this course? 5% of what? The calculated amount or the recorded amount? 5% of the recorded amount. So let's just go ahead and do that. 2,200,000 times 0.05. So we have to be within $110,000. It's like The Price is Right. $110,000 without going over. Although you can go over, it has to be within a range. Are we within $100,000? No, we're not. Okay, we're not. So they're reporting a much larger amount than we would expect for this. And it's revenue. What do you guys think? Just based on your experience in accounting, do you think revenue would be a high risk area for most organizations? Has there ever been a company that's ever overstated their revenue? Doesn't happen very often, does it? Yeah. Nah. So maybe we are okay with this. Obviously, revenue is a big area. If they're overstating their revenue, there could be nefarious reasons for this. We could not accept this. We would have a trouble accepting it if it was on the far end of the range, but this is way outside of our expectation. So I think our conclusion is that even though we did a lot of analysis, we added a lot more variables, a lot more items that we could calculate to try to get a more specific estimate, we're still way off. So we probably need to rely on more substantive testing of revenues than try to use an estimate, because we think that there's probably a lot of variability and volatility in their calculation. This is not to say that $2.2 million is wrong. This is saying that we cannot develop that expectation using an analytical model. So all of that work that I made you do for homework, it was for naught. You still got more work to do. You know, fortunately, you're going to do that in other sections, so don't worry about that. All right. Last thing to talk about. This is one of my favorite exercises. I will allude to this exercise many, many times over the course of the semester. Okay. So I think this exercise is very simple and straightforward, but it also provides context for testing that we haven't talked about before. Let's go to the actual folder that I'm in. Actually, close that. Inventory testing. All right. So basically, you had to fill out 2 work papers here, and you are helping out with an inventory count. And some of the inventory counts have been information has been put in here. You've obviously got a sample, and some of the sampling's already been done, which is great. There were 4 items for each of the companies, which is really nice, because unfortunately, if you do an inventory count in reality, you won't just have 4 items. You'll have quite a bit more that you'll have to do. But I think that this kind of gets to the heart of the matter, and we need to talk about what's going on here. So with respect to this assignment, something that you're doing in this particular scenario is, oh my gosh, I'm gracious. I usually have notes on this so I can actually track and make sure that I've got the numbers correct, and I don't know where my notes are. All right, so you're gonna have to help me out here, guys. You're gonna have to help me out. So basically what we've got here is we've got 2 tests. We've got one where we're looking at the number that's on the floor, and we're comparing that to the sheet. And they can describe that in the procedures. They say floor to sheet and sheet to floor. What do those mean? Okay. Well, the floor basically represents people have gone out and counted everything on there. They put tags on the inventory saying, here's the number of items that are on the inventory. This is what's actually in the warehouse. All right, that's the floor count. The sheet is a printout of something that's in their accounting system. This represents what's in their inventory count on their accounting system. And this distinction is really, really important, because depending on what we're looking at to start is actually going to evaluate what it is we're trying to test. So multiple assertions can be tested as part of this, but given that we're starting with one and going to the other, that implies direction. Okay, it implies direction. So if I'm starting with the floor, I'm starting with stuff that I know actually exists and comparing that to information that's in the system. What direction am I moving? Moving, yeah, bottom to top. I'm starting with the source and moving to the system. Okay, I'm already moved to the record. So that's testing what? Moving this direction is tracing. So that's completeness, okay? That's completeness. On the other hand, if I start with the sheet, if I start with what's reported in the system, I say, this is the amount that's in the system, and then go walk onto the inventory floor and look and see if it's actually there. I'm looking at what's recorded to see if it actually exists. I'm moving from top to bottom. Sorry, I didn't mean to spit there. All right. Should stop using the letter P altogether. Okay. All right. So top to bottom. And then that means that we're applying existence in that particular test. That's going to be your result if you actually look and see what's going to be happening here, because we're going to have some violations. Now, it's important to note, this is not a catch-all for every single one of these assertions. This basically means that you have to use your judgment based on every scenario, because we are going to have some misstatements, but it doesn't necessarily imply that it's always going to be completeness or always going to be existence occurrence. We're going to talk through those. So here's what I want. All right. For medium sweater, I'm pretty sure that there's no disparity here, but what's the number? What's the number in the quantity inventory count tags? This is we're on the Germany warehouse for the Florida sheet count. 84,300. Okay. 383. So 84383. Okay, and that's for both, correct?
Yep.
I do remember that much, that they are the same number. All right. So what is our conclusion here? What is our conclusion? Are there any violations or any issues? No. The number that's on the floor amounts to what's recorded in the system. That's our happy spot. That's where we're saying everything's good. All right. Photo here. What is the number that's on the inventory count tags? 5034? 9734. Did I get that right? Okay. And I believe, if I'm correct, this is a 0 here. Okay. I could actually pull these up. I've got the documents here. I don't know why I'm making you guys do the work. You know, you guys pay me to do the work and I'm having you do it for me. But it doesn't seem fair. It doesn't seem fair. All right. So what's going on here? What's going on here? We've got something on the floor that if we go and look in the system, it's not there in the system. It did not get what? Recorded. It's not recorded, which means it's a violation of which assertion? Completeness. Yes. Did not get recorded. So if we're going to describe any violation, we're going to say completeness. We probably would want to say more than that, but for our purposes here, so I don't have to type out, they violated completeness. They did not record this particular this particular item. We know notes exist, it's just not in the system. All right. I'm gonna open the. Yes.
It was technically still recorded, but right, it just wasn't recorded correctly because they reported it as a 0.
So basically you would say that if there's nothing in there, you would say it did not get recorded. There's no record of it. You say you could actually have an item in the system. So that could be a pre-existing item. Because they probably sold this item in the past, but they don't have any. And so we know that something was purchased at some point in time, maybe multiple times, maybe just once, in all likelihood, just once. But that item, these 9,734 items, did not get recorded because they're not in the system wherever they are. And so that's our concern. All right, let's go ahead. And so if I remember correctly, this one, there's no problem with this right here. Is that correct? But there is a problem here with the medium sweaters. So what is the number on the inventory count tags? 9687. And if I'm correct, this is 9678. Okay. So what's going on here? So yeah, what's likely here is that we've got a transposition of numbers. So we know that on the floor that there's 9,687 items. And so it's possible somebody came in and says, you know what, I want 9 medium sweaters. I'm taking these home with me. All right. That's probably not the likely scenario though. What is the most likely scenario? We'd say that whoever's typing it in, when they put it in, they put 9,678 rather than 87. It's an easy transposition to make. Assuming this is a transposition error, and I think that's probably a logical assumption, that means that this amount was not in correctly, which is a violation of which assertion? VAA, yes. This is not that something didn't get recorded. This is that something got it recorded at the incorrect amount. Does everybody understand the difference here? Okay. Seems like dicey. It's like, well, they're both wrong, Dr. Barnes. What do we care? It says, well, that it actually depicts a problem in their system if that's the case. In one scenario, something just didn't get recorded altogether. which is a much bigger issue than something not getting recorded the correct amount. Both are issues, but the nature of the transaction, the nature of the exchange of what was supposed to take place is substantially different given the circumstances. So even though these both represent errors, they represent different types of errors, which is important to note. All right. Now let's go over here. There's nothing wrong with the Germany warehouse. Is that right? Okay. So the only thing we have wrong is the large t-shirts down here in Japan. Is that correct? So what was the quantity on the inventory status report? So the amount on the sheet was what? 2342. So 2342 on the sheet, and then is it 0 here for this one? Okay. So we've got another issue. So a completeness violation, right? Yeah, you didn't fall for my trap. You didn't fall for my trap. So why is this existence occurrence rather than completeness? Yes, we're looking at what's in the system. We're saying this is what's been recorded. Let's go find it on the warehouse floor. Oh my gosh, what's in the system doesn't exist. There we go. So we've got an existence occurrence violation. Now, interesting question. This didn't happen, but what happens if, like down here, the briefcase, and I'm just going to make up a number. So I'm a 1, 2, 3, 4, 5. Okay. And then I look at 1, 2, 3, 5, 4. What's our violation there? That's VAA again. Okay. Now that's not what happened, but again, the differentiation here being it's exactly what happened in the scenario, but it looks like one got recorded in incorrect quantity. Okay. So, and it's likely that this was recorded the incorrect quantity because we would look at what the count tag is and assume that's correct because that probably was written down since that's the most recent evidence. So that's consistent with our VAA assumption. But the big distinction here is understanding the difference between sheet to floor and floor to sheet. If we're talking about floor to sheet, we're looking at information that's live. We're looking at evidence that's right in front of us, something that actually exists. We can use what actually exists to determine, did something get recorded? All right. If the answer is no, then there's a violation of completeness. The other hand, if we look at a sheet, we see what the numbers are, and we go and compare that to what's in the warehouse, and there's nothing there, that's a violation of existence occurrence. Those are our two primary concerns. And then we can use some ancillary tests, like if we can look at improperly recorded amounts to test a third assertion, VAA. So each of those had different scenarios where we actually saw violations here, and they should be clearly distinct for you. If you can understand the distinction, you should feel pretty good about where you stand with your understanding of those three assertions in particular. Now, the good news is those are the three most important assertions to understand. And if you felt pretty good about that analysis, you're a long way in. Bad news is there's 4 or 5 more assertions, depending on how you count it, 4 or 5 more assertions that I'm going to likely test you on, which you have to understand those assertions as well. So don't just rest on your laurels and say, well, I nailed that inventory assignment. I'm going to say, well, you're 3/8 of the way there if you got that, okay? Because I will ask you questions about the other assertions. So please make sure you're clear on those as well. Yes?
So if the actual inventory is also like overstated, it still be, it doesn't matter that it's 0 or if it was more than what's reported.
The actual inventory is overstated?
How is it greater than what's on the sheet, it would still be inside.
So usually in this situation, if we're talking about this scenario, if we're talking about something that's easily identifiable, like a transposition error, that would probably be VAA, just simply because we'd say it was just recorded incorrectly. Now, if we're talking about something like, say, for example, this is 1, 2, 3, 4, 5, and the actual number was 5,000. That would probably not be a VAA issue. That would be an existence occurrence issue because it looks like that some amount of inventory at some point did not get recorded, which is an important distinction to make because there's no relationship between these two numbers here. So at some point, 7,345 items were not received. Okay, they were recorded, but they're not in the warehouse, so they don't exist.
My question is, does it matter if that quantity is greater than what's on the sheet?
Yeah, so if the quantity was greater, like if it was the opposite error, it's like, say, for example, this was 20,000, then we would say, all right, why is the number greater here? Is there a completeness issue that we're concerned about here? Because you can actually infer the opposite, but in that case, we would be looking at a number that's larger.
Okay, so
Generally,
it would be the opposite.
Yeah. Generally speaking, when we talk about a sheet to floor testing, we are focused on completeness, and floor to sheet, or sorry, floor to sheet is completeness, sheet to floor is existence occurrence. But yes, you can definitely infer other assertions depending on what the relationships are. The good news is I will tell you this flat out. If I ask you this on an exam, I will not try to trick you by throwing larger numbers in the the left or the right-hand column to try to make you infer what's happening in those situations. The relationships you see will be one of these three: completeness, existence, occurrence, VAA. But that is an excellent question. And that's actually the first time it's ever come up in my classes. So gold star. I don't have any gold stars. So, all right. Any other questions? All right. As I said before, Monday, please come in prepared to ask questions, complete the exam in advance. Be prepared because you get one shot at this and then the exam comes up. I'll see y'all then.
Really?